All right, so we should do the calculation today and then do the written one tomorrow, right?
Yeah.
Okay, is everyone buying into this idea? Is everyone buying into this idea? Everyone buying into this idea? Good. Okay, all right. So let's start. Beginning in the name of God, Father, the Son, and the Holy Spirit. Amen. This is basically last year's question. So the first question here is cash flow. So we are saying IS1 presentation of financial statements set out overall blah 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 and everything. And the requirement here is, so let's read the additional information. Goodwill arose the acquisition of unincorporated business, and during 2022, expenditure development project totaled 200,000 was capitalized, right? And also during 2022, a plant with a net value of 100,000 was sold for 110,000. Depreciation charge in the year on property, plant and equipment totaled 50,000. Salvation Limited acquired rights of use of the plant valued at 60,000 by means of lease arrangement. Annual rental payment being made in arrears on the last day of each year. The current asset, the current asset investment is a core account with a maturity period of 1 year, of 1 month. Sorry. The new debentures were issued on 1st January 2022. Finance costs include debenture interest, finance lease, financial. Okay. So during the year, Salvation Limited made 100,000 bonus issue, capitalizing it within and is following by a rights issue. During preliminary discussion of the financial statement of 10 February 2023 by the executives, the CEO expressed shock about the 31st December 2022 cash position. He did not understand why, instead of profit of 18,000 and in 2021, both cash and balances would get worse in 2020. He suspected an embezzlement of the of finance director. So this is the main reason why we are creating this account. We are coming to create the cash account because the owner is suspecting that Obi DKB, that's the reason why. And that is cash flow is 30 marks. So at least if we see cash flow in this year, when you're able to solve cash flow fully, you are getting 30 marks, right? Say if you cannot do anything, when by the end of today you should at least be able to do something. Like at least we know boys, if Obaba and at least don't have at least for a crazy because you know accounting is being marked by ethics, so you don't have to leave it like that. At least so the cash flow account and CASA is 20 marks, and then the notes or the workings that you'll be doing is 10 marks. Wow. So let's kick start. Please, do you mind if I use okay. Oh, hurry up. Uh-uh. Please, I hope you are seeing my screen right.
Yes. Yes.
All right. So we are seeing a whitish white something here. So let me divide this board into two, and then make one side. Let me make one side the workings of. Um, all right. So let me divide it into two, and then make one side the workings, side, and then make one side two. There. All right. So remember, in accounting, don't always forget the name of the company starts first before you do any workings or any. The name of the company is Salvation Limited. So we start with the Salvation Limited. Then we are coming to do statements of cash flow for the year ended. So statement for cash flow for the year ended 31st December 2022. All right. So let me bring the citizen here. Three zero. All right. So we start with cash flow from operations. So basically, in doing the cash flow in our slides, we start from cash flow from operating activities. Not even in the slides though, but I think that's the general rule for IAS 7. I don't know if I'm wrong there. So we start with operating activities, right? So cash flow from operating cash flow from operating activities. Or should I use okay, let me use Excel to do this and then do the workings here on it. Or Mm. Okay. All right. So cash from operating activities. What we normally start with is our profit before tax. So we start with our profit before tax. Also, please let me just start with profit before tax. Oh, I don't really need to do this. All right. So now we start with profit before tax. So profit before tax. And then profit before tax here was given as 360. Sorry, 340. Right, 340. Sometimes you can, okay, you can, all right. So profit before tax here is 340. So we bring it here, 340. Then we add finance cost. And the finance cost here is 17. So we bring our 17 there, right? So if there were to be income from an investment, right, we will adjust it here. But since there's nothing like that in this question again, to close this account here. Yes. So fulfill the name operating profits. So add the two and we get our operating profit. So this is our operating profit. So now what we are coming to do next is we are coming to adjust for non-cash income and cash. Like you see, there are some parts of the trading accounts which was recorded as profit or expenses, but it's not cash related. Things like depreciation, right, was taken out of the profit, even though it wasn't cash, right? Depreciation, impairment, profit on disposal, and the like. So that's what we are coming to treat here. So what we are coming to do now is we are coming to adjust for non-cash income and expenses. All right, so we start. Depreciation was taken out of cash. Out of the profit, right? And it is not cash related, so we add it back to it. So we add depreciation, right? Adding depreciation. All right, so adding depreciation. Depreciation was given to us as depreciation charge in the year on property, plant, and equipment totaled 50,000. So we bring out 50,000 here. I've written 3 zeros here, so we don't need to add a 3 zeros. Then we add, okay, let's check whether there is an impairment before we add it. So let me just go here working. So working. All right. So for me, using T account to do this makes it easier for me, right? So I normally like it. So this can be, we can either test for impairment or amortization since it is intangible. So so we open our intangibles account. So working one intangibles. Then I open my T account. Right. This makes my life easier. So I like to use this. All right. So for the intangibles, right? When we check in our statement of financial position, we can see that development expenditure is an intangible. So we have a balance drawdown of 160. And in the income statement, anything that is at the asset side is having a debit balance, whilst anything that is at the liability and like at the liability and equity side is having a credit balance, right? So that is it. That is one key things I use to analyze them. So anything that is at the asset is having a debit balance, right? And anything that is at the liability is liability and equity is having a credit balance. So second here, the development expenditure is at the asset side and it's having a balance here. So I'll bring it at the debit side. So balance brought down here is 160. So I come here, balance brought down 160, right? And then in the year, they told us that there is capitalization. They also during the year, expenditure on development projects totaled 200,000. So meaning that they increased or there was an additional project that was added to it. So since it is an addition, it will come here again. So additional projects, let's say additional projects. And it was 200,000. Bring my 3 zeros here so that people don't get confused. But now, checking in again. Apart from these two, there is really nothing again that was added to it. So I come in and then take my balance brought down here. There's a balance brought down here again, which has a debit balance, but it has a debit balance. There'll be a carry down before the brought down. So let's bring the carry down in here. So carry down will be here. And the balance carry down was 290. It is more or less like using control accounts, right? Incomplete records, that formula. Yeah, so let's check for which one is big. And here is 360, 360. So since there is a difference here, which is reducing the intangibles, and there is an impairment or amortization, any of them, right? Which is 70. We come here and we add impairment or amortization, and it is working 170, right? And then profit on disposal, with less profit on disposal. There was a disposal here, which was the net book value for the asset was 100,000, and then it was sold for 110,000. Right, so there's a profit here, so that's what we are going to do. So into brackets, 110 minus 100, right, and we are going to get 10. So minus 10. That's to be able to get it. Right. So aside this, there is no adjustment for non-cash income and expenses again. So what we are going to do is we are going to close this account, then bring it to it. So let's go to, so that's it here. So now, since we are done with it, now we come and do adjustment for working capital. It looks plenty, but once you solve it 2 times, you will get it. So now for working capital here, we are only coming to do with the inventory, payables, and receivables. We won't touch cash and cash equivalents, right? I come to touch inventories, payables, and then receivables, right? So in these payables and receivables, when it is an asset, right? When it is an asset, we add the decrease. We add decrease in assets. And then we less increase in assets. The thing is that when it comes to debtors, the reason why debtors will decrease is because it's come and paid. They've given you cash. So the decrease will be added to your cash flow because they've come, like they've given you money, right? So that decrease will be added. And then when it comes to payables, right, the reason why payables will decrease is because you've paid out, so your cash has gone. When it comes to payables, when it comes to payables, we less decrease because you've paid, right? You've given cash out, and then we add in pay. So you can put this down. So now let's check whether there's an increase or decrease in any of the payables, inventories, or receivables. So when there's an increase, you can say creases, right? So let's come to inventory, right? So looking at inventory is an asset, and I said that for assets we add the decrease and then we less increase, right? So looking at it here, inventory initially was 227, and then it has increased to 360, meaning that you've bought more, so your cash has gone out. So you are going to less the cash that has gone out, right? So we are going to find the difference, and then we are going to less that. So in here, so less increase in inventory, right? Then it's a bracket. It used to be 227, and now it has changed to 360, right? So when we find the difference, we are going to get minus 430. Remember, we are less section. Then now, let's check on debtors too. So can anyone unmute him or herself and then tell me what has happened to debtors? Has debtors increased or decreased?
Decreased.
It has decreased. Yes, since I've seen your message in the chat box. Has it increased or decreased? This is
Decreased.
okay. So this is the receivables. Oh, please. Is there any other person who is also not hearing me clearly? Please, is there any other person who is also not hearing me clearly? All right. So please, patient, can you maybe increase your volume? I'll try my possible best and also speak audibly, and I guess for free. All right. So um, it has decreased. So since it has decreased, what we are going to do is we are going to add the decrease, right? So going to add the decrease, we add decrease in receivables or trade receivables. Into brackets, it used to be 227,8274. It has changed to 352. Right, so the difference is going to be, hey, what am I writing? 324. It has changed to 274. So the difference is going to be 50. All right. Then what we are going to do next is we are going to also check for the payables. Let's check for the payables. So payables, trade payables, it has changed from 352 to 274. Please, has it increased or decreased? And what are we going to do with it? Are we going to add or subtract or less?
It has decreased. It has
Okay. And since it has decreased, what are we doing? We are subtracting, right? Okay, okay. And, okay. So patience, checking my mic here to have increased everything. I've increased the mic to the fullest. So I don't know. Increase the mic to the fullest. Alright, so now let's decrease in payables. Right. And then decrease in payables has changed from 274 to 352. And the difference here is 78 minus 78. Very good. So now this is what we've adjusted for in the working capital. So let's close this. So this is what we have here. Then now what we are going to do now is let's add them. Add them again one. That makes much fun. All right, so we are now getting our operating cash because we've adjusted for everything. So we are getting our operating cash, right? So after getting our operating cash, we have to take out our interest that we've paid and then also our taxes that we've paid. So we are coming to do that now. So we less tax paid, right? So let's go and work. Let's go and do a working for the tax paid. All right, patience, you can. Okay, all right, all right. Thank you. I'm glad. So let's adjust for the tax paid. So working through tax. All right. So now what we are going to do now is let's go to our statement of financial position. All right, our statement of financial position is here. And then we have tax here. Tax is at the equity and liability side. We have deferred tax here, and we also have current tax here, right? So what did I say that when the item in the statement of financial position is at the credit side, what balance will it have? To have a credit balance. So that's what we are coming to do here. We'll bring it to the credit side. What is this? So balance brought down. Remember, we are having two balances there. We are having a deferred tax and we are also having a current tax. So what we are going to do is we are going to add them. The 2021, we are going to add the two of them. So we are going to add 153 to this 70. Okay, to 45. 153 plus 45. And that is going to give us 196. Right. And also in our profit and loss account, we paid for some tax there. There was some tax recorded in there. And the expense will be added to the already tax. So now 160 will be added to what we have now. So P&L 160. So another thing here I've been using so far is that in the profit and loss account, when anything is an expense, right, it has a debit balance in the profit and loss account. But in the normal account, it will be at the credit side of it. So we are moving from the credit side of this tax to the debit side of the profit and loss account. But when it comes to the balance sheet, it maintains the same balance as it has in there. Sorry, as it has in there, right? So now, let's now come back to our statement of financial position again and look at our closing balances for the taxes. So our closing balance, we have 48 for deferred tax and then 56 for current tax. So that will be our balance brought down here. $48 plus 66. And then we are going to get 104. So now, when we close this account, we are going to get this plus this 358. 358. Right. And then the difference between this and this one is going to give us the tax paid. It is 254. Right. So our tax paid is going to be 254. So what means 2? Negative 254. Then we also come and deal with our interest paid. All right. So lessen our interest rate. We also have to work for the interest. So let's also find out workings for the interest. Hope you are not giving up. Don't give up, okay? So working 3. Right, interest. You see, you have to number them so that these are the ones that is going to give you the additional 10 marks. So you have to do them step by step and number them so that you receive your 10 marks. Now, for interest, debenture interest, we have nothing here. Okay, the question is okay. Let me forward it right now again. I'm forwarding the group again. I'm coming. Give me some few minutes to forward it. Where is the script? I have forwarded it to the group. Alright. So now for opening balance, we have nothing for the debenture interest. We have nothing for the interest here. So what we are going to do now is we have nothing for balance drawdown, right? But we paid an interest in here in the profit and loss account, right? There's an interest here, which is the finance cost. Sorry, it's here 17. So this interest is an expense, right? And it's at the debit side of the income statement. So credit it to our interest account. So P&L, profit or loss account. We have 17. Let me write it well. Right. Okay. So there's nothing in there again, unless our closing balance here. We have a closing balance here of 5, right? So it will serve as a balance carry down here. 5. Thanks to patience, Pearl and then Jerry. They explained this to me. I wasn't really understanding this, and they did it well for me. Thank you very much, guys. All right, so interest paid. It's now going to be 12. So we are going to bring working 3, right? Always remember them. Working 3. Negative 12. Negative here. Now, when we less everything, we are going to get our cash flow from operating activities. So basically, net cash flow from operating activities or operating profit. Okay, let me do it then. So this is our operating profit. We are now done with the first batch of the cash flow. Is there any question up to this point? Is there any question before I move on? Is there any question? All right, no question. Okay, no question. Then I move on. We are now moving on to. We are going to look for the cash flow from investing activities. Right, and basically investing activities deals with long-term assets, or let's say fixed assets, right? It deals with fixed assets. So that's what we are coming to do here. So now we start first by looking or checking whether we purchase an asset, like meaning we purchase a fixed asset or if not purchase a fixed asset. So let's go and do a workings for PP and then see whether we purchase a PP or we didn't. Right, okay, I've received a message. Let me check. For the non-cash adjustment. Can there be interest and as in from investment?
Yeah.
From investment.
Yes.
Okay, so for non-cash adjustments, I'm not sure there can be interest earned there, because the interest earned, for example, hasn't been added to the investment, right? I remember this same question was asked in the class, and then the lecture was that it will not be added, like it will not be, it's like, I don't know how to, like, you take it out of the profit that you have, like your operating profit. So you can, if you have it here, if you have interest in, right, you subtract it from, or you add it to the non-cash income and expenses. So what you are coming to do is you have add depreciation, add impairment, you less your interest in, right, from it, like the same way as you less profit on disposal. That's what the lecture says. And I'm a boy. Me boy na. Don't see me.
Oh,
Because I
no,
remember
you're
that's what
correct.
the lecture said. That's what the lecture said. So now let's go to from cash flow, a cash flow from investing activities, right? All right. So it deals with, as I said, fixed assets and the like. So let's check whether we purchase a PPE or we don't purchase a PPE. So let me do workings for, right? Workings for. Yeah, I'm saying a baba. I'm out of Soviet mamma. Who beside me question? Me baba Maria and Baba so who beside me question? May the answer. All right, so PP. All right. Patient, don't mind me, okay? I'm just joking. All right, so PP. Let's use our same principle, right? As I said, in the statement of financial position, when we see anything at the asset side, right? It has a debit balance. And then if you see anything at the equity and liability side, it has a credit balance. So let's come here. And PP, plant property and equipment, it is at the asset side, so it will have a what? A debit balance. So let's start with the 2021 estimate is 6, 637. So balance go down. 637. Right. All right. So 637, and then where is it? And then in our footnotes, they made mention that there was a depreciation of 50,000 on the plant property and equipment. Remember, depreciation is going to reduce the value of the asset, so it will be credited to this account, depreciation. It is 50,000, right? Then there was a disposal of an asset. Disposed an asset which was worth 100,000. So disposal too will come. And then what again? And then there was there was a right of use asset. They acquired a 60,000 worth of plant here. So it will increase the PPE we have in our account. So right of use asset, right of use. It was 60,000. And then there was a revaluation gain also. Yeah. So there was a revaluation gain here, 100. So we have to come and then add it to it because it will increase the revaluation gain. Or you can put profit or loss account today. And it was 100. Right. So now what we are going to do now is we are going to close the account and see. At the end of the distance, DPE was having 825 balance. So balance carry down. 825. Now let's close this account. Let's close this account. So when we add all these three, which one is bigger? Because the credit side is bigger than the debit side. So this thing is 975. 975. So since the credit side is bigger, then there was some pitches. So pitches of PT, which will be the difference between them. And the difference is 178. So pitches of PTE, NFTP working 4, right? And then it was minus 170, minus 170, because we are paying, we bought with cash, we are giving cash out, so we are subtracting. So less purchase of it. All right. So now we also move on to disposal of PPE, right? When we dispose, right, we get cash, right? So we add disposal of PP. And it was, in the question, it was 110, 110, right? Let me confirm. Hey, it seems I'm copying Mr. Right. So let me change. Okay, right. Okay. So 110. Yeah. So that's the same thing we settled here. Then we also capitalize, or we have a development cost. So less development, right? And it was development cost was 200. So we paid for it minus 4. So we can charge this now. All right. So now we are done with cash flow from operating activities, right? So what we are going to do now is we are going to do for cash flow from financing activity. Cash flow from okay. So from financing activities. So basically we are coming to deal with our equities, yes, our equity side, and then some of the liabilities, like issuing of equities and liabilities and those kind of stuff. So that's what we are coming to do with it. So we are coming to check whether we've issued shares or we've not issued shares and the likes. So let me also do that working in. It's either you can do them one by one, but I prefer creating a statement of changes in equity to do all of the equity distance. Maybe debentures, then we do the debentures differently. So statement of changes in equity. So working 5. A does one equity. So um please who you have your mic on, kindly mute yourself for me, okay? Pardon, turn over. So checking here, we are having 3 components at the equity side, which is share capital surplus, and then retained earnings. Capital surplus is also the same as revaluation gain or revaluations. Yeah, something like that. So we will have 3 sides in here. 1, 2, 3. Right. We have capital surplus. Okay. We have what? Share capital. Share capital. We have capital surplus. Cap surplus. We have retained earnings. Have retained earnings. So now we start with our balance drawdown. Then our balances at the beginning of the year was 560 and 255. So bring them 560, 255. Right. So now we are coming to do it. We are coming to check whether there was any movement in or movement out, right? And in our footnotes, they made it. They said something lively here. As in Kofana Buijuma Pan, so yes, I'm come say during the year, Salvation Limited made a bonus issue, capitalizing its retaining. So they made a bonus issue. So bonus issue means they've issued like another share. This a bonus issue, and they paid with their retained earnings. So bonus issue here will increase and here will decrease, and they will all increase. They will all increase. So also we also had a revaluation gain. We will bring it to the capital surplus. It was 100. Right, it was 100. Let me see what that. Yeah, okay, it was 100. Then what again? There was also uh, profit. Profit will come to us. So profit, yes, is 180 for that year, right? So let's leave a space and then close this account. That's all for this. So you see, we are using one stone to kill three birds. We're killing share capital, we're killing capital surplus, and retaining earnings in one account. So that's what makes it system. So when we check here, what is our closing balances? So let's bring it here. Our closing balances are 850, 160, and 229. 850, 160, and 229. So let's check where there is a difference. Here in the shares, there is a difference of 250, meaning that we issued shares and we had money. Right. Capital surplus, as soon so that's, and then retain earnings to, there was some difference in here. When we check, it was around 106, and it is negative. So it means that we paid some dividend, right? So we say cash from shares stroke dividend pay. So dividend paid is in the bracket, and then cash from shares is not in the bracket. So let's go here. Then we add cash from shares, and that was 250. Then we also pay dividends, so less dividend, and that was 106. Right. Then there is ventures there, with it, and then there's also lease liability. So let's do with debentures. So for debentures, debentures is more or less like issuing bonds and the like. So when you issue them, you receive money. Right. So when the changes has gone up, then it means you've issued more and you've received money. But if it has gone down, then it's the vice versa. So checking the debentures here, it's increased from 110 to 150, meaning that there has been an increase. We've issued and we've received money. So the difference is the cash being received. So what we are coming to do is, okay, to add cash for issued. Right. And then it was 110 minus 150, right? And then 40. Here will be negative, sorry. And then lease liability. Lease liability, now we have to do working for lease liability. So let's open an account for lease liability so that our workings can be easy and straightforward. So we will know we will know for this particular question. It is some umbrella and have to some umbrella. So working 6 lease liability. So now let's check again. Let's check. Police liability. We have all of them at the equity and liability side. So they have credit balance in our T account. So the opening balances are 70 and then 12. So balance go down. 70 plus 12. Okay, 80. Right. And then in our thing, we lease an asset which was worth 60,000. We have to bring it here. So lease 60. And then now there's nothing more again. All we have now is the balance brought down. The balance brought down here is 100 plus 17. So we will carry it down here. 100 plus 17, 117. Now lease payment, if in case there's a difference. So when we add the two, let me check. 142. So there's a difference here, and the difference is 25. Minus 25 because we paid for lease. So let's use that payment. So let's add them now. Alright, so this is so after getting everything for the cash flow from financing activities, we bring it and then we add it to our operating profit. So operating profit plus and cash flow from investing activities plus the cash flow from financing activities. So this is the formula here. Add all of them, and then we are getting this as a decrease. Right. So what we are going to do now is we can either check whether it is valid or it's not valid. So what we can do here is we are going to add the opening cash and cash equivalent balance. So when we are done, we are supposed to get the closing cash and cash equivalent balance. So when you are done with this, you add opening cash and cash equivalents. Which is going to be into bracket. Our cash, opening cash and cash equivalent here is going to be our investment. They said it's a 1 month something, so it is cash equivalent. And the cash here is 117, right? And we also have an overdraft here. We have to let it out. So it is going to be 46 plus 117 minus 54. So the 50 is overdraft, right? So it is going to be like this. 1146 plus 117 minus 54. And we are going to get one. Right, so we add them and we get it. So if we want to check whether this is correct, let's check our closing cash and cash equivalent, right? So closing cash and cash equivalent is 143 plus 29 minus 132. So yes, sir. Fine, thank you, sir. Kakrebi. 1 4. Imagine number poker. Hey, we are me can you say me rate 143 plus 2 minus the last one. And I mean to me yet you were poor no. I did three numbers you can raise. Hey Jesus. So you see, it is 40. So if you do this and it is equal to this, then bingo, where did you? So we are done with this question. Is there any question? Is there any question? Is there any question? Oh, see me. And these are the workings. Okay, I'll do that. Should we continue, or I should send a picture of the other solvings, of the other calculation solvings to the group? I feel say, yes, sir. And I answer. Okay. Okay. So cash and cash equivalents, when you are done with everything, you want to check whether what you've done is correct. You have to let your closing cash and cash equivalent from your opening cash and cash equivalent. So also, when you want to get this, which is the negative 69, right? You can let your closing from the opening, then you get it. So let me do that. Okay. So go to this, go to this. I should damage calculating this thing. It's going to be I'll touch it again. Closing this is going to be 143 plus 143 plus 2. All right, so the cash and cash equivalent is what we use to check whether what we've done is correct or it's not correct. So when you are done with the cash flow and kasa, and you've gotten either your increase or decrease, you have to confirm whether it aligns with the closing cash and cash equivalent. So to do that, you are going to add your opening cash and cash equivalent to it. And then if it is correct, if it is indeed correct, so I think for tax relief, it will become a non. So for I think for tax relief, right, it will become a non cash income, right? So since tax relief, normally they will add it to their income also. So if they will add it to their income, then what you are going to do is you are going to subtract it from, you are going to list it in the adjustment for non-cash income and expenses, right? That's what you are going for the tax relief. That's what you are going to do with that. And then so in the income statement, that's what you are going to do, right? So for the ones that is in the balance sheet, that's what you are going to do this adjustment to it, like what we did here, like what we did here, like what we did in here. You are going to do the same adjustment. So it's when you want to find out the tax fee, right? You are going to do this adjustment to it. Is the question answered? Please. Okay. All right. So the one who asked for the cash and cash equivalent, is he okay? Yeah. Hello. Are we okay? Should I go over anything, or we are okay? All right. So should we continue or?
That's no more interview. You know me, no, they get Jimmy.
Should we continue? Okay.
Yes.
So I was like, see, tax relief they will add it to their income by all means, right? So we have to come in and adjust it from the cash flow for non-adjusting, for the non-cash, right? So we will come and then less it here. And then when we are dealing with the tax paid to, we will add it to, like, we will adjust it in the T account for us to know our tax paid, right? So it will have more or less like two treatments, one here and then one in the T account. All right, that's fine with me. That's fine with me. So our next question is going to be okay, let's tackle the financial instruments. Are you ready?
Yeah.
All right. So now let's deal with the financial instruments. So for the financial instrument, what is the company's name? The company's name is called Walter. All right. So a financial instrument is any contract that gives rise to a financial asset of one enterprise and a financial liability of an entity instrument of one entity forget it. Instrument for another enterprise. Consider the following transaction in the books of Water Limited. So on 1st January 2019, Water Limited issued a loan note with a 50,000 nominal value. It was issued at discount of 16% of the nominal value. So meaning that 16% of this is a discount. The cost of issue were 2,000, sorry. Interest coupon is payable annually in arrears, right? So in arrears means at the end of the year. So basically, when we are doing the amortization schedule, when it is in advance, it is done differently. And when it is in arrears, it is done differently, right? So in my solvings, I'll talk about when it is done in arrears and then when it is done in this thing. Okay, in advance too. All right. So the bond must be redeemed on 1st January 2024 at a premium of 4,611. Effective interest rate is 12% per annum. All right. So let's solve this first, and then now we tackle the next one, right? So this is a financial instrument, right? And this is a is it a liability, right?
Yeah, it's a liability.
So in the books of who water limited, always remember Saudi company doing the back. Or I should be saying so. We're gonna be water limited. Charlie. After Thursday, na akuma to yim kaka na even facing marketing. All right. So now what we are going to do is we are going to find the initial recognition, right? Initial recognition is going to be the value of the asset or the value of the liability being issued, less the cost of issue, and then less the discount, right? That's when we will get our initial measurement value. So initial measurement is going to be initial so the nominal value and then the benefit. No, all right, so the nominal value will come. Then on my Bali, you're at the Akoyabon for 60,000. Then there is a cost of issuance of 2,000. So we will less it. Then there is a discount, 15% discount. Right, so our initial value, please kindly mute yourself for us, okay, beg. So the initial value for the financial liability is 40,000. Do we get it up to this point?
Yes.
Do we get it? Do we get it?
Yes.
You don't get it. You don't get it.
We do.
All right.
All right.
Can you tell me exactly what you do that time? Can you tell me what exactly you don't understand so that please? Hello, I'm waiting for you. All right, so now we have the initial measurement. Now let's go to the subsequent one. So the subsequent, so the subsequent measurement is when we bring out our amortization schedule, right? So
You are laughing. I see her too.
So subsequent Jesus, they have you. They say a bomb and they bring out our amortization schedule. Daniela. Daniela. Oh, why is she gone? Okay, for that.
Oh, I shall wait at the offer than I lie.
Oh, me say last semester, yeah, we know presentation. No presented for, but I just schedule. Not stop our something.
Yeah.
All right. So for this amortization schedule, we are going to open 5 sites. All right. Let's open 5 sites. All right. So we start. So we start with the year. Then we move on to the opening balance. Then we move on to the finance cost, which is 12%. We move to coupon payments. They did the VNSM or has it. Money sending. So let's calculate our coupon. Our coupon is going to be, what was the percentage? Coupon is 5%. So 5% equal to 5% times 50,000. This is what makes, sometimes this is what causes the confusion. Remember, coupon is not paid on the initial measurement value or initially financial liability value, but on the nominal value. So you calculate the 5% on the nominal value. So here is going to be this. Going to funding negative, so that's very good. So this thing was purchased on 1st January, right? The 1st January, it was issued on 1st January 2019. So on 1st January, we will have here be 40,000. That will be the initial measurement. So that's when we bring the initial measurement. Now, on 31st, yeah, because we pay in arrears, so we pay at the end of the year, right? So we bring our figures here equal to this. Then our finance cost is going to be 12% on this. So 12% on this. Right? So 12% times this. We have done. I didn't tell you to do this on the template for me. So this is it. So now what we are going to do now is we are going to add this 48,000 to this, and then we less this. So it is going to be this plus the finance cost minus the two complements. That's what we are going to do. Yes, normally. All right. Please, do we get it up to this point? If you don't get it, let me explain here before I move on. Yes, there was an issuance cost, issuance cost here. Yes, it was 2,000. And there was a discount too. Do you get it? So that's what I did for the initial measurement. Are we cool? All right, so we pay for the first year. All right, so now let's go for the second year. You see, one thing about this arrears thing is that for the arrears, what you are going to do now, what you are going to do is, because you are going to pay at the end of the year, then it means that finance costs will be added to the opening balance, right? But if you were going to pay at the beginning of the year, you have to first, that is in advance, you have to first subtract the coupon before you find the finance cost. But since it is going to be paid at the end of the year in arrears, then what you are going to do now is you are going to add it to this before you subtract the coupon payment. Do you guys get me, or I should go over again?
Go over, please.
Please. Okay. All right. So in advance, meaning that you are paying at the beginning of the year, which means that interest rates wouldn't really affect the balance, right? So what you are going to do now is you are going to take your coupon payment out first. So it like it is going to be for if for advance in advance. This is how your finance cost is going to be. It is going to be the 12%. The 12%. Okay, let me be 0.12 times into brackets this into bracket this minus the coupon payment, right? Because you are going to pay initially at the beginning of the year. So you have to take it out before you find the percentage of your finance cost. So you see, for that one, the finance cost is different. You see, the finance cost is different. So you see,
Yeah,
but for this, so for yes, so for this one, we are paying in arrears at the end. So mean that finance cost will affect the opening balance. That's why we find the finance cost on the opening balance, right? So meaning that in arrears, we find the finance cost on opening balance, but in advance, we find the finance cost on the difference between the opening balance and then the payment, right? Are we cool? All right, so now let's go to the next year, 31. So even the question is saying that here, the question was saying that we should just demonstrate how each transaction will be accounted for during the period of 31st December 2019, right? So this is more or less like 2 years. No, it's only 1 year, right? So they are telling us to do it for only 1 year, but I'm trying to do it for the 4 years that they are trying to say. Sometimes you have to do it for the 4 years, and then you check whether is it true that they will get this premium amount on it, and then you know whether you are correct or you are not correct, right? But this question is only asking for 1 year. So 1 year amortization schedule is okay, right? But I'm doing more than that. So now, so this is here. I'm just using Excel to pull everything in here. So now our finance cost here, for example, when we pull it down, Excel will do it for us. How do I move?
Please, the closing balance. I had 42300.
Yeah, it's supposed to be false information. Oh, sorry. I misinterpreted the formula here. I should just add all of them because I have made some negative errors. Sorry. Thank you. Thank you very much. It was because of the formula. Because I've made here negative already and I indicated negative there, so I need to let me just put it. Let's check my phone for normal but not for results. So remember, you see we have this similar question here. In the exams, right, they might they might try to twist it by saying that they are rather paying in advance. Right? If they are paying in advance, then you use what I just said. So if they are they can bring the same thing, they will just say that they are paying in advance. That's all. Then you get confused. You go and do arrears and you get it wrong. Right? So you just have to step fast. All right. So now everything has been done here because of Excel. The work has become even easier. Is there anything in here that we don't understand? Is there anything in here we don't understand? Please, do you have a question on this? All right, so let's do in a scenario of, so this is for advance. This is for arrears, right? Should we do it should we do in a scenario for advance so that we will get a glance on the two? Should I? Or time is not on our side? All right. So let me do for advance and then. So this is for arrears and then let's see for advance. So that one too.
Please, the first line of the table, is it necessary?
You said?
And the first
Is it
line,
not what?
is it necessary? Like,
Oh no. I just brought it there so that you know what you are dealing with.
okay.
Yes. Just that in the advance it will be necessary. Let's see. See that the advance will be necessary. So but I didn't schedule for that. Yes. Copy this program. And sister, open shortcut 1, 2, 3, 4, 5. Open shortcut. And All right. So with advance, all right. So let me explain this here. Remember in the question, this was what I was trying to say. Remember in the question, they said they want to redeem it at a premium of 4611 at the end of the year, right? So look at the final answer in here. What are we getting for the final answer? Remember the initial amount is 50,000, and we are getting 54,612. So it's only 1 city difference, so it is normal. So you see, we are getting 4611, but here it's just 4612 because of the decimal. That's the reason why. You see, this is what will make you see that what you are doing is correct or it's not correct. You get it?
Yeah, so about this side, why is it that the other time in class, some people were saying that they needed to pay the coupon and then the face value?
That will be here. But remember, this is you issuing a liability, right? So you are going to like pay it back. You get it? So when you bring this amount here, this closing balance in here, it is going to be 0, and it is still the same because it's a liability, like bond that you've issued. So since you've issued the bond, right, you are going to pay your money back, and then the coupons too at the end of that particular system. And because it will be at a premium, so you pay that premium. So when I bring this amount here, this 4612 here, it will turn to 0. You get it? Very quick, pass me the paper. Very quick. Thank you very much. Okay. So plus the 50,000 minus it because you are going to pay that one. Minus the 46.
I think it should be plus because okay.
No, it's supposed to be minus. Thank you very much. What kind? I won't say something. Put Diego. Wait, see. Are you cool now?
No,
Maybe
kindly
the last year. No.
I'll see. You did
Okay.
50,000 as
Okay.
a
So
premium.
no, 4611 is the premium. Yeah. You see, the 50,000 is the normal amount that is the bond value, right?
Yeah.
You see, in the last year, you are going to pay the coupon, you are going to pay the bond, and then you are going to pay the premium. So they will all be part in the payment here. So I don't even need to pay. I have to only leave it to payment. So payment.
Okay.
I hope it's fine.
Yeah, senior, yeah.
All right. Okay, sure. All right. So here in advance here, for example, you are paying in advance, so 40,000 will be here. Remember, our payment is going to be minus 3,000. Same thing throughout. Then because we'll be paying at the beginning of each year, so Jara Safari. Right. So
And
Now,
then one thing I
because
noticed is
we
that
are going.
mostly for the advance,
Okay.
uh, the payment comes before the finance cost.
Oh yeah, but you can do it the same thing and then it will still be the same. But if you are not going to be confused, for me, using the same table, I'm not going to be confused because I know what I'm going to do. But for less confusion, too, we can do it that way. Because I know that I'm going to subtract. You see, I remember I told you I'm going to subtract before I find the finance cost, right? So this finance cost here is going to be equal to 12%, 0.12 into bracket this minus my payment because I'm paying in advance. I'm paying at the beginning of the year, so um, uh, interest rates or the rates will not really affect it. So I'm taking the amount that I'm paying out. For that one, the amount that I'll be paying at the beginning of the year, interest rates will not affect it. That's why it is this way. So enter. Yes. All right. So this is it.
The payment is
So
already
here,
negative too in the
yes, it's
formula.
negative.
Now I mean the one you had for the 55,500. You see the negative.
Oh,
There's
okay,
another.
okay, okay, okay. Okay. Yeah, thank you. Okay, thank you very much. Yeah, it's already negative. Anyway, this abonning with me. Yeah, first one, I'm saying abonning medium. Yeah, we come on it 2 times. So let's talk about 2 times. So equal to the last also to type 1, 2, 3, 4, 20. I guess any other section. Okay. Now this will create as a review. And this will be paid at the beginning of the year. So it's not really tallying with uh, the first one. I'm sure it is because the advance will have a different premium amount that maybe they will be using, but it will still be the same thing. 1, 2. It's supposed to be around the same thing. Because the payment is 1, 2, 3, 4. Okay, wait. So 1 up to 2020. Page January 2024. 22, 2020. Hey, I'm not getting the same thing, but today is how it's supposed to be though. But I'm sure maybe that one will be having a different premium amount also. So one, because if we are to do it that way, this time, which is like 4 years here, is also going to change. So if they bring an advanced question to, so basically it's also something like this plan. So with the advance, as I said, because you are making the payment at the beginning of the year, right? You are going to take it out first before you find your finance cost. That's the only difference in here, right? But since for the arrears, you are going to make it at the end of the year, right? You are not going to use that at the way you did for the advance, right? It's just the vice versa. So please, are we clear up to this point? Are we clear up to this point? Wow. Please, are we clear up to this point?
Yes, boss. Yes, boss.
Okay, then let's do for the B. Then we do for the financial statement for both of them. So this one is also saying that on 1st January, Water issued at par 8% convertible loan note with a nominal value of 600,000. It is redeemable at par on 31st March, or it may be converted into equity shares of Waters Limited on the basis of 100 new shares for each of 200 of loan notes. An equivalent loan note without the conversion option would have carried an interest rate of 10%. So we've already done the first one. So let's do the second one, and then we are going to demonstrate it in the financial statements. Remember, they are saying only 1 year of it. All right, let me finish this, and then tomorrow we'll meet early and then do the reporting segment before we proceed. I say 2 hours they do. You say 2 hours. So remember, this is a compound instrument, right? Because look at it. This is a compound instrument because it has a loan, it has an equity liability in it, and then it also has a liability component in it. So what we are going to do now is we are going to find the present value of it, right? Because it is redeemable at 31st March 2022. So we are going to find the this thing in it, and then we extract our liability and equity component from it. So let's do that straight away fast. So what we are going to do is our initial measurements. So I initial measurement for what you are going to do the schedule that we can use our normal bond formula to get it. But accounting is marked with 6. So if you use the normal bond formula, using the normal bond formula, what you are going to do is you are going to find the present value of the cash flows plus the lump sum. So the bond formula that you use, then you are going to at the end plus everything over. And we can use the same thing, but accounting is marked with 6. So I think when we do it that way, we are going to lose marks. So let's do the step-by-step thing. That will make us get more marks, right? So let me put the year here. And then let me put cash flow here. Then let me put discount factor. And let me put present value there. Okay. So remember in the question they said it is redeemable at 31st March 2022. So meaning that here is going to be 31st March 2022. Now our cash flow is going to be okay. So this thing is 600,000. And then it will pay 8% cash flow. So 8%. So the TA said because here is 3 months, we are going to multiply it by 3/12. Right. But here will be the final year. So in the final year, we are going to pay back our 600,000. Please, are you following? Or Yaira? Yaira, na? If Yaira, I'm can't.
Right.
When you're right, I won't. Okay. All right. So now let's do the discounting factor. Remember, the interest rate is 10%. Interest rate is 10%. So you're coming to use that one as a discount factor. So I'm coming to do this in Excel. 1 times, or I can do it 1 divided by 1.1 raised to the power. Oh, it's still the same. Then here will be equal to 1 divided by 1.1. Will be a shortcut. Now, this is the issue in another. Right. So, divided by. Will be in formula B and I'm any simple now. 1.1 raised to the power 2 then equals to 1 divided by 1.1 raised to the power of. I say, Jerry Bisa say, should they divide it by or see that we should leave it like this. So let's do it like this. Okay, the reason why the last cash flow we are getting 612,000 is because at the last year we are going to pay the cash flow and then we are also going to pay the full money back, which is the 600,000. And then the cash flow we are going to pay it in March. So what we are going to do is we are going to multiply that 4,800, 48,000, sorry, times 3 divided by 12 because it is 3 over 12, right? So we'll be getting 12,000. So 12,000 plus the 600,000 that we'll be paying. That's why we are getting this. Is it okay? Is it okay now? All right. So now, for us to get our present value, we are going to multiply this by this. So equal to this times this, then we get our present value. Bring all of them down. All right. So now this is our. Listen now. When we add them, when we add them, this is what we are getting. This is what we are getting when we add them. So now, if we want to get our equity components and the liability components in this particular compound instrument, we are going to subtract this from this. So now, So this is going to be our liability component. And then it's going to be our equity component. Hey, sorry. Hey. Equity component. Sorry, the liability. All right. All right. So this is our equity and liability component. Are we okay up to this point? Are we okay up to this point?
Yes. Yes.
All right. All right. So now, all right. So now what we are going to do now is let's draw our amortization schedule. And then for the amortization schedule, what we are going to do is we are going to do the amortization schedule for only the liability component. The equity component there, we will not do amortization schedule for it, but for the liability component, we are going to do amortization schedule for it. So subsequent measurements. So this amortization schedule will be for only 1 year. So I think super cloud, let's say. All right, so as at 31st, when it starts, let me just bring the opening balances. All right, so let me start from the beginning of the year. We'll be having a lease liability of this. It should be the same as this. Subsequently, at the same year now, 31st, 2, it's going to be this. I'm going to check the question. I will say. So our finance cost for this, we are assuming this is being paid in arrears. So the payment for this is going to be 8% on, let's say, right? And then because it's going to be paid in arrears, then we calculate everything on this. So equal to the finance cost is 10%. So 0.1 times this one. So long to get so that will be cheap. Right. So this is what we'll be getting for our amortization schedule for for only 1 year. I'm limiting myself to 1 year for this. And we can continue down. Because the question is demanding 1 year. Now let's do for the income statement extracts, right? So let's start with the income statement extract. Income statement extract. We are going to get finance costs. It's only 1 year. Okay? The finance costs we are going to get interest. It's assignment convertible loan. And this was this. And then we're also going to get loan notes. For the first one, just here. Right, and then so that's it for the income statement. Let's go for the statement of financial position. We like to make it this because it's Tuma ade su ọmụ mmanya mfa Excel nye bibie. Calculator popra. So what we are going to do is non-current liability. So we have 8%. Just equal to this. Then we have two notes. So this equals to and then that's all the text in there. And now you have an equity. To bracket reserved equity. The one that we got from the testing. All right. So this is it up to this point. I don't know if you have any question for me. Is there anything I have to clarify? Is there anything I have to, yeah?
The loan note under the
2,300.
He said
the loan
Loan note,
the loan
note
note
under
42,300.
income statement were 4,800. Is it
4,800.
supposed to be 48,000, right?
No. This
Is
is
it
for the
48,000
loan
or
note, the first one,
4,800?
not the convert. No, this is not for the convertible loan. This is for the loan note, the first one that we did, the finance cost, the one that we were doing in arrears. There's it. See, there's a difference between the
Which one?
loan note and the convertible. The loan note is what we did the first one. This one, the first one here,
okay.
the I.
Okay.
You get it?
Yeah, I get it.
And then the convertible loan is the second one. So, yeah. Is it okay up to this point? Kindly, for the this thing, kindly, if possible, kindly take a screenshot of these, because I'm not sure the workings. I'll be getting them. This I'm not sure I'll be getting them. So if you can take a screenshot of the workings, then for the Excel I can put them in the group. But if they take a screenshot of the workings, if in case I'm able to get it and then post it in the group too, I'll post it in the group. But if I'm not able to, then you have a screenshot. If you want me to move down, then you tell me. Please, should I move down?
Please move down.
Yeah, okay. Then should I move down?
Yeah, you can move down.
Okay.
I think you would have to lower the this one, the size. Okay.
Okay. If I lower the size, it will be small.
It's fine now. Oh, you increase it a little.
Oh. Wait. Is it okay now?
Yeah, but you can kindly move it down a little bit so that I can see. Yeah, change it. Okay. Yeah, you can move down. Yeah, I've taken a screenshot.
All right. All right. So we will have to meet early tomorrow and then do for the. All right. So subsequent, go for the subsequent measurement amortization. Okay. All right.
Please, can you show the balance sheet
Oh,
again? What the-
you said can,
Can
can
you show
I
the
show
balance
the
sheet?
Excel sheet?
Yeah.
Okay.
You combine both questions in the statements of financial position.
Yeah, they are all the same. It is in one question because at the end they are asking you to demonstrate how both of them. They can do them in
Oh,
one
okay. So
financial
you put them
position.
under like one. You didn't separate them.
Yeah, it is separated.
Okay. Thank you.
You're welcome. So if you're able to do the balance, let me say the cash flow, and then this thing, you've gotten 60 marks already. Cash flow is 30. This one is also 30. You've gotten 60 already. Yeah, cannot do on start to no one and where but there na on our con. So looking at how things are going there, maybe tomorrow 6 o'clock, or what do you guys think? 6 p.m. Is it okay? Tomorrow 6 p.m. Yes,
Please
you
go. Bossman, please go to the
Is
Excel
that to
sheet.
go over?
No, go to
Okay.
the Excel sheet.
Yeah, I'm at the Excel sheet.
We didn't record anything under current liability.
No. It's only 1 year, right? So since it's only 1 year, there will not be only current. There will not be any current liability. I think if it will be multiple years, that's when there will be a current liability. All right. So tomorrow, we will meet and then we'll talk about this. See, maybe most of your interest in kakra na yewe no. What is it? The theories. These theories, we have to talk about them. Free market theory, liberalism theory, agency theory, and the rest. We will talk about them tomorrow. We are not to meet on side 5 and 1 when you're 10 marks on. And also, operating segments, we will talk about it tomorrow. And then accounting policies and estimates, where the bonus question come in. And then, when a week a crazy, where is it? Okay, at least we are. Can you listen to you?
Abi,
Tomorrow we have
them
to also
send
do
some.
the list.
Okay.
Is it?
Now then send some
This
link.
list,
Abi,
then
the
do
one.
what?
Abi the one that CSA go share plus, the link, so say go spy the list video, no. See.
Oh, don't worry. Tomorrow, the list is just like the financial instruments, no.
Mm.
In the financial instruments, tomorrow, if you do my go, say no difference day. Difference day, brain, no share that day like that. The same amortization schedule, nah. But just that for list, you have two measurements. Either you can measure the lease liability and then the right of use assets. So the right of use assets will only have depreciation. You have to less depreciation. And the lease liability, you have to amortize it. And that's the only difference in there.
All right.
So tomorrow we are going to do it. Tomorrow they will move fast. All right. Thank you very much for joining today. And I hope we enjoyed it, right? I hope we enjoyed it. We understood things, right?
Yeah, we understood things.
Okay.
We love you.
You say?
We love you.
We love you too, okay?
Hey, you
Oh, okay, bye.
Charlie, I go see you.
Is that what?
I say I go see you. You know me this thing,
No. Be this thing, This one be different one. Get up.
So Charlie later, okay.
Yeah, I will send the Excel straight away. All right, sure.